Zillow says you need $230,000 in income to buy a home in San Diego. Oh my God. But I just helped a couple making $130,000 close on one. So which is it? Today I'm going to break down 3 real scenarios at 3 real price points and the income that actually qualifies you to buy a home in San Diego. No fluff and no generic national stats. My name is Tristan Campanella. I am a local real estate agent here in San Diego, North County. And look, everyone says something different about what does it take to buy a home in San Diego. You've got one side saying that you need $1 million cash, and then you have another side saying just get an ARM, which is an adjustable rate mortgage, and figure it out later. Neither one is giving you the honest version, and both could be right on your scenario. So let's break this down. As of today, the day I'm making this video, the median price for a home in San Diego is hovering right around $1 million. Could go down a little bit, go up a little bit, but that's the countywide number. Definitely over $1 million for North County. Now listen, that number can be very misleading, and here's why. That median includes La Jolla, includes Del Mar, it includes Rancho Santa Fe, includes every coastal zip code where the average home is $2 million, $3 million, $4 million. So if you're watching this video, you're probably not shopping in La Jolla. You're probably looking in the $850 to $1.5 million range, which is where most of my buyers live. So let's get into what it would really take to buy a house in today's real estate market in San Diego. I'm going to be using today's rates, and actually I'm going to use the higher rates, the 6.7 for a conventional 30-year fixed. And I'm going to assume that people are putting 20% down because that's just the cleanest math. If you're putting less down, your income does need to go up, and so does your credit score sometimes. And I'll get to that. Scenario 1, $900,000 home. That's a single family home in places like Vista, parts of San Marcos, definitely Escondido. Let's say you're putting 20% down. That's $180,000. Your loan is $720,000. At 6.75%, your principal and interest is about $4,600 a month. So add the property tax at about 1.1%, and that's another $825. Homeowner's insurance, about $180. Let's assume no HOA on this one. So your total monthly payment is $56.75. Now, the old rule of thumb is that your housing payment should not be more than 28% of your gross income. So $56.75 divided by 0.28%, you'd need a gross income about $243,000. Well, don't freak out. This is what most people miss. That's the conservative number, okay? Most lenders will let you go up to about a 35% DTI, which is debt to income ratio. If you don't have a bunch of other debt, okay, you've got to get rid of that debt. So if you have 0 car payments, no student loans, no credit card debt, you could qualify at roughly $194,000. That's the real floor for a $900,000 home with 20% down, okay? So, and the real truth is that when you live in San Diego, you're definitely going to be paying more of your income towards housing than that 28%, okay? So as long as you are comfortable with it, then you can definitely make that work. Okay, let's look at scenario 2, $750,000 townhome or condo, or a small single family home, maybe in Escondido, maybe. 20% down, $150,000. Loan is $600,000. And then you'll be paying about $38.85. Tax is $688, insurance $150, HOA, let's call it $300. That's being really nice. Total would be about $5,000 out the door. Income needed at 28%, $215. But if you increase your DTI, only $172. Scenario 3, super entry level, $600,000. This is a condo in North County with 20% down. That'd be $120,000. The loan would be $480,000 that you would be borrowing. Your principal and your interest together would be $3,100. Taxes estimate $550, insurance $130, HOA $375 because condos have higher HOAs, total $4163. Okay, if you're at $178,000 in income, but at 35%, only $142. So if you're making $130 to $150, yeah, you can buy in San Diego, but it's going to be a condo, and you're going to have to work on your debt. It might be the first one you're going to buy, and then you can move up. Okay, here's the thing that most videos like this skip, and it's not just the income, it's the down payment. 20% down on a $750,000 home is $150,000. Most people don't have that sitting in a savings account. But here's what actually is happening in the market right now, and this is what the headlines miss. I'm seeing buyers get into homes with 3 to 5% down using conventional financing, or even a 0 down with VA loans. So if you're VA, ding, 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 ding. The catch, your monthly payment goes way up because you're financing more. And you're gonna be paying private mortgage insurance, which if you don't know what that is, hit me up and I'll walk you through it. This adds another $200 to $400 a month, depending on your credit. So let me redo scenario 2 with 5% down on the $750,000 home. 5% down, that's only $37,500. Much more doable, but your loan is now $712,000. Same rate, principal and interest, $46.17. Your taxes are going to be $688, insurance $150, HOA $300. Now we're having to add private mortgage insurance of $300. That total just went up to $6,000 a month. That is $1,000 more than the 20% down scenario income needed at 35% DTI. So now you'd need $207,000, right? Different. Same house, same rate, just less money down. That's the difference between qualifying and not qualifying for a lot of people. So what does this mean for you? It means the income isn't the number one thing. It's a range, anywhere between $130 to $250, depending on your down payment, your debt, where you're willing to buy. And this is where I have to be honest with you guys. If you're trying to buy in the coastal cities like Carlsbad, Encinitas, Solana Beach, your income is going to need to be a lot closer to that $250,000 or higher. But if you're willing to look 15 or 20 minutes inland, Vista, San Marcos, Escondido, that number can drop significantly and you can get into the housing market. Same North County commute, same weather mostly, very different price points. The couple I mentioned at the beginning, the one making $130,000, they bought their very first home, which was a condo in Vista. They have a 2-car garage, a little patio, and they're 20 minutes from the beach. It's not a mansion, but it's theirs. And in 3 to 5 years, they're gonna have enough equity to sell and move up if they want to, or keep it as a rental and then choose to move to a different house. Quick pause. If you're watching this and you're actually running the numbers on whether you can buy San Diego, don't do it alone. That was really fast. I went over that really fast. So just reach out to me. I can give you a budget worksheet. You can call me, you can text me, or you can click the link in the description. I do this every day and I will tell you straight whether it's possible, and I will help give you a 1-year strategy plan. There's no pressure, no sales. I'm just looking to give you some honest numbers. So here's your quick cheat sheet. 5 income tiers, 5 realities for buying in San Diego in 2026. $100,000 to $130,000 you can buy. It's gonna be a condo, maybe definitely inland, okay? You're gonna need to have minimal debt and some down payment. A lot of people are getting help from their families. If you're making between $130,000 to $170,000, condo, townhome. This is a sweet spot for first-time home buyers. $170,000 to $220,000, you're starting to look in the single-family home range, Vista, parts of San Marcos, other parts of San Diego, okay? If you're pushing $220,000 and higher, you can start to play in the coastal cities. Carlsbad, Encinitas, even right on the coast and Oceanside. There's nothing bad about making $300K, it's just a different conversation. If you're making more than that, right, you have a lot more options. So the income you need to buy as a home in San Diego is not the number one thought. It's a combination of your income, your debt, your down payment, and where you're willing to look to purchase a home. Most of the doom you see online is either using countywide medians or pretending everybody has 20% down or needs 20% down. They don't. It just is very individual. The one thing I tell every buyer right now is don't wait for perfect. The buyers who waited for 4% rates, you guys are still waiting. And my other buyers are making equity. So I don't know if that's ever gonna happen again. Get in the housing market. Build equity, move up. That's the play. I hope to see you guys on the next video. Remember to smash that subscribe button, and thanks so much for watching.